Good everyone, you're welcome to another lesson here in the Forex Manual of IOC Forex Academy. In the previous lessons, I've told you about some things. We have talked about understanding money. We have talked about money management. We have talked about some rudiments of Forex, how for you to gauge your risks and your reward and the mindset you have to go in with that. I've talked about a little bit about the foreign exchange market. I've explained some things with respect to that. I've also talked about compound interest and money management, how myself or as a beginner, to go into the marketplace with an already made plan. You have a strategy, you have a plan on how you intend to compound your money. You don't just base on luck, you don't just base on if the market favors me, I will come out successful. No, you have a straight plan and you want to execute that whenever you come into trade. So you have an interest to trade using your trading plan and looking on how you can compound at least ×2 of that. You measure the time it took you to do that, and you try to use that time not going above your risk disclosure of 1 to 3%, and you do that and you compound your money. And we saw significant amount that it amounted to when being done over a long period of time. So I said, most importantly, that when you want to reduce that time it took you, you don't increase your leverage, you don't increase your risk, no. Rather, you get in, you fine-tune your understanding of the marketplace, how you can come in and get more opportunities to be able to increase the daily and therefore weekly returns that adds up to that big monthly returns that you want to give you ×2 of your account balance. So I talked about some things in the previous lesson. If you have not watched that, I urge you to go back and see what I said there. It's very, very helpful. In here, we are going to be talking about price action. So we are going to be talking about price action here, and it's a very important and crucial lesson that you need to know coming into the gates of this marketplace. So in here, I'm going to be telling you more about how do you know when the market will go up, when it will come down, all those things. I'm just going to be unveiling it to you. Although, just like I said, it's my intention to really teach you these things, but all these things cannot be done in just one lesson or in just one course, and we are giving this out for free. So it's not going to be possible to teach you all I know here and what makes for my own consistent profitability in here. But I'm going to be giving you some things to look out for, and you are going to start seeing and understanding the marketplace from a clear point of view. So let's not talk much. Let's just go right in. So price action, I believe this is the lesson most persons that have already been trading have been waiting for. They want to know, IOC, why does the market go up when it goes up? Why does it come down when it comes down? Where will I put my stop loss? Where will I enter? Where will I exit the marketplace in profit? All those things become questions one gets to ask once they come into this field. So I'm going to be unveiling that to you in this course. So price action, let's jump right in. So I normally keep some quotes here for you to take as a guide as you go down through, so you don't forget. So I said my ability to trade the way I do is due to the fact that I know these models, the position, the swing, the short term. I know them down to my fingertips. I know exactly what I'm looking for when I come into trade. I am not guessing, rather I am definite. So I know what I'm doing. I'm specific. I don't come in and say, oh, if the market is like, I know what I am looking for. I am definite. If you have heard me say on 1 or 2 occasions, I say that Forex for me now is getting boring because I don't do something so new again. Although I increase my skill on this, I'll have to say that I increase my skill on this, but I improve mostly on money management. You understand? How do I manage my money more better? That's where I improve. So I read more books on that. I read more books on money management Understand? I love to manage my money in my account. But anything as regards to getting the market, whether to go up or to come down, all those things are not new to me again. I've come to the full understanding of why price goes up when it goes up, why price comes down when it comes down, where I will enter, where I will scale out. All those things, I have them to my fingertips. Understand? So I said that my ability to trade the way I do is due to the fact that I know these models. I know what it takes to be a position trader. I know what it takes to be a swing trader. I know what it takes to be a short-term trader. And all these things I'm going to be outlining there. You're going to know the meaning of position, swing, and short-term in this course here. So all these models, I know what I'm looking for. When I come into trade, I'm specific. If I get knocked out, I know why. And I don't force the market, you understand? I don't force the market. The market respects who respects it. So if I'm having maybe a hectic day, if I'm having a hectic day, I'm having something, I'm too busy and I'm not focused on my chart and I take a loss, I don't do revenge trading. Oh, I lost $1,000. Let me trade to make it back up. No, I know what I am doing. So even if I get knocked out, I will say, oh, what did I miss here? What did I miss here? And it does not take me so long to recover back on my losses. I tell you, it does not take me too long to jump on back in profits. It does not take me too long because I know what I'm doing. I'm not perfect. I don't have all my wins. I don't make money every time I trade, but I'm consistent, I am profitable, and I must account for profits whenever I trade on a long scale. Sometimes it can be minimum. If I trade in a week, I must see profit at the end of the week. Understand? So that's it. So I must see profit at the end of the week. I might have a losing day, but I recently do not have losing weeks. Understand? So that's how you need to come into this market with. You need to know your market. If you went to school, you spent so many years. Some went to your primary school, you went to secondary, then you went to college, you went to university. So if you spent, some person spent over like 20 years just getting a degree and even furthering, understand? So if you can spend that much in school, what makes you think that Forex is something that you can just come 1 month and you'll be able to do what other persons that have been doing for years? You understand? This is an art, it's a skill, and you need to respect it. You need to respect the rules of the game. You need to know what you're doing when you come into trade. You need to be specific. You need to know your instrument very, very well. So let's just go down. So price action, what's price action? Price action simply refers to the method of analysis of price movement in order to generate trade entries and exits that's considered reliable without requiring the use of indicators. So price action is trading just with the chart. The chart tells you what it wants to do. No line indicators are those lines, all those modifications, all those additives they add to charts to be able to tell them where the chart is going. But I'm not a big fan of indicator, and certainly speaking, I don't trust indicators. I've used indicators in the past. I have used all sorts of indicator from your MACD to your address side to pivot points to I used harmonic patterns, your fish, your crab, your so many, they'll call so many animals for you, butterfly, and so many rubbish. Understand? I've traded using even retail, what retail traders call price action. That's not what the institutions call price action. The retail traders will tell you about their support and resistances and how all those things work. I'm here to tell you that those things do not work. Just you just follow me. Those things do not work. They do not work in this marketplace. The market does not respect your order. The market is not about buying and selling of retail traders, and you cannot move price. The person that control price, they control large liquidity that the retailers do not have. I'm talking about millions and billions of dollars. When the market is being able to control $6.6 trillion on an average in a day, will you tell me that it is retail traders that account for that large number? No. Understand? So you need to come to the understanding. I don't consider indicators as foretellers of price. They don't foretell you what price do. I consider them as things that follow price. They are lagging. They don't lead. They are lagging. They come behind. So if the price is going up, at that point, they will show the indication that it's to go up. Understand? It's late. You should have the signal before even it gets there. I know that price wants to buy at a certain point, weeks and months, sometimes even a year before it gets there. That is knowledge of what you're doing. Before it gets there, you know what it wants to do. Weeks, months, years before. I told my students, dollar index will trade like this for the full year. It would go like this for the full year. That's knowledge of what you are doing, not a particular something telling you what is happening per minute and you think that is correct. No, it's following what is being printed. If you want to test this and you come in during times of high volatility in the marketplace, sometimes when news pumping in the marketplace, you will see the kind of manipulation being done and you see how your indicators will just fumble. I was using exponential moving averages, and when my moving average was meant to give me a particular pattern to be able to buy, the market have already gone. Then the moving average obeyed what the market was doing. That's late. That's late. As a trader, you should already come in before. Most of the trades I trade, 99% of them, they're not instant execution. I trade mostly on pending orders. I see where it should go. I place my order. I go and sleep. I go and do my work. I go on with my business and I come in, I see what is already running. That's knowledge of what you have to do. Not to be looking at the chart and every time you want to look at something, if it goes up, then I will buy. If it comes down, I will sell. That is slavery. Understand? The forex market is not meant to be that tedious for you. It's meant to, once you know what you're doing, you still go around with your life. Because if you're taking trading like that, then working a 9-to-5 job is even more better than trading because it's less stressful. If you'll be looking at your screen every time, if you're looking at the screen, you'll be stressing yourself just to get in and monitor a particular line that is going up. That is stressful. So I'm not a big fan of indicators, and I will tell you why. So let's go down. I said here in IOC, we trade without the use of indicators due to the fact we know that the market is being manipulated and thus indicators cannot be able to lead price, rather they are seen lagging, thus following price. The market is very unique, consistent, and dynamic. It is active and it changes with respect to recent market conditions. It is not static. Take a look at what I just wrote here. Just take a look at it. Indicators are not leading, they are lagging, just like I've explained. The market is very unique. Your indicators they were created with a particular underlying structure to follow and to be able to paint a particular pattern when they see a particular structure in the marketplace. And the market is not static. It is dynamic. Market changes with respect to time. It changes with respect to condition, just like you have your winter, your summer, your autumn, and your spring. The market changes with respect to time. So there are some points the market does not want to do what it did last month. It wants to modify. It wants to change. So how will your indicator that was created to follow a specific structure, how will it be able to adapt to the recent market conditions that was being created recently when that indicator was created years ago? It is not done like that. So the market is very unique. It's consistent. It's dynamic. The market is not random. It's not random. Despite the fact that I said that it changes with respect to time, the underlying factors for which it does its modification, those factors are not random. And I will tell you what are those factors. They are not random. They are specific. They know what they are going for. And it will even interest you to know that this market hunts for retail traders. It hunts for uninformed money. It hunts for those who do not know what they are doing. So if you come into the forex market, you want to say you want to buy a house, you want to buy a car, you want to buy this and that, you want to quit your job and retire. I'm sorry, that will not be the case, because you have to give it time. You have to give it time for it to pay you in such manner. Understand? So the market is not static. It is consistent. It is not random. It is consistent. It is not random. It's dynamic. When viewed from an institutional perspective, these markets are beautiful as the concept in which the algorithm uses to respect the driving up and down of price is being respected in all asset classes. And this model can be understood in a single phrase. The underlying factor with which the market, the algorithm, there's an algorithm that prints price up and down. It is not buyers and sellers. Your market is just like a code, understand? An algorithm is responsible for the printing out price for you, because of we are just in like in the age whereby almost your computers do everything. You understand? So the factor to which the algorithm sees as the base to pushing price up and down can be understood in a single phrase. Price trades to seek yield. The market trades to seek yield. They trade to seek liquidity. They trade to seek liquidity. This is very deep. The market trades to seek liquidity. Price goes up and down to seek liquidity. Now, liquidity can be seen, I don't want to take you through the literal definition and all the rest, but liquidity can be seen as something that makes it very smooth for you to go. It's liquid. It's very smooth, you understand? So liquidity is a point of ease. It goes for the point of ease, to the point that is sweet. Take it like that. So liquidity can be seen the point of ease, the point that is sweet. Now, when we say price trade for seek liquidity, the market always trades to points that are so easy for it to offset. So where are those points? And it will interest you to know that liquidity is seen in your stop loss orders. Anywhere retail traders, they put their stop loss, anywhere uniform money. There are also some persons that trade large funds, but they trade with the mindset, not with the institutional traders. Those persons are called uniform monies. The traders too that trade with that same mindset are called uniform money, while those that trade with the mindset used to drive price, they are called smart money. So it's not as if it's a competition between smart money and uniform money. I'm just giving you the different classes of traders when viewed from an institutional perspective. Understand? So price trades to seek yield. It seeks to take out uniform money. The stop loss of those that trade with concepts not viable to institutional mindset, they are seen as uniform money. And once price takes out their stop loss, they have gotten liquidity. So the market, without liquidity, this market cannot move. Without liquidity, it cannot move. It needs liquidity to move. And I will show you practically on the chart. After the market takes out liquidity, you will see speed. Why is it that when you trade on your chart or anywhere, you see that as soon as they took me out, the market reversed with speed and went in the right direction? They are monitoring me. They are not monitoring you. They passed out an information. If you want to observe, this market is being controlled by a strong set of persons and organizations with large funds. So how do they make sure that when they come out to do their hunting for liquidity, there is always meat there, meat that can never run dry? There's always food that they can never run dry. There will always be retail traders that will trade with uniform money mindset that can never run dry. What is the only way? If not to teach everyone the same thing. They pass out an information. Trade with the news, read the news, do this and that, use indicators. They passed out and information that is general. If you observe, when you bring in change to something and they even fight you and everything, that's because of it is generally accepted. Understand? That's why I will not be surprised if some persons even fight with this knowledge and say that, oh, it's not true. If it's not true, just test it. That's the proof of use all these things. Test it, go back to your charts from the 90s, from the 80s, go back and check. If you find anything that is not consistent with what I'm teaching you, come back and tell me, and I will give you $1,000 minimum. If you find anything that is not genuine, that is not, you said the market trades like this, and I went back to GBP USD 19 something, I will even give you more than it's a blank check. Any amount you want, I will give to you if you can prove that right. This market is not random. The market trades to take out liquidity. It goes for the easy point. They send out an information to everyone, learn this. So when everyone is operating with the same information, have you asked yourself, I bet you no one watching this course must have seen what we are teaching in our class outside. You don't find it outside. But you go to this Forex Academy, they teach you some things, but when you go to this other person, he's still similar, but they just tweaked a little bit of things. They just change some indicators, change some languages, but they're still saying the same thing. That is general information. When they go out to hunt, you see that they're taking those people out. And when they want to explain why they're taking out, they say that the market just decided to do what it wants to do. Sometimes market want to do what the market does not want to do anything want to do at any point. No, it's not random. It's specific. It's not what it's doing at every point. It's not random. That's what I want to pass out here. So it trades to seek yield. I said, come to T-Confit. Do you think the largest financial market in the world was created for everyone to benefit? This market was not created for you to benefit from. No matter what your broker tells you, they are giving you 10 times bonus. Once you register with them, they will multiply your money. The market was not created for you to benefit from. This is the largest financial market in the world. When even in your social space, we see different aspects of it being controlled by some close set of individuals or organization, thus a market producing. So I'm saying now, in your social space, like in politics, in your educational system, you see that there are some persons that when they say yes, their yes stands. And it's hard before someone can come and change that particular order. Sometimes it's even next to impossible. Understand? So how do you think that in the largest financial market in the world, there will not be manipulations? There will not be people that will be able to control this thing, organizations that are bent on profiting this thing. And they are. This is their playhouse. This is where they make their money from. You understand? So I said, thus a market producing over $6.6 trillion cannot be driven to benefit everyone. But there's a way out. We trade like the institutions. Instead of trading against them or being the prey, we join the predators. So the market is about predator and prey, those hunting and those being hunted. We want to shift from being hunted to hunting other people. Understand? So that's just it. Don't say I want to pity them. No, you hunt other people. You join the big players. And how do you join them? You learn their model of driving price. You learn how they do things, and the model does not change. It is consistent right from the genesis of Forex, of the financial market. It does not change. So if we happen to know down to the core all the components of their model, then we can start seeing significant progress in our trading career, and we'll be able to understand the marketplace better and see beforehand the footprint of the market makers and able to trade alongside with them rather than against them, as many retailers do. So you see me call some price, and I've been consistent over the past months. I've been saying that the dollar will go to this point, and it went there. Euro went to this point, you went there. GP went to this point, went there. It's not by magic. I don't do all those things by magic. I understand what I'm doing, and I know it's down to my fingertips, and I stick to it. And I'm coming from a great deal of experience. Understand? So it's not by magic. We see beforehand, months before, weeks beforehand, sometimes a year before, we will see what the market wants to do. Understand? So that's knowledge. That's knowledge. That's knowledge. So I said there is a rule here I give here. It's called the 90 to 10 rule. I said the 10% will make 90% of the money in any field do the thing that the remaining 90% of people do not do. That's simple to understand. This rule also applies to the foreign exchange market, where funds are controlled by market makers and not by buyers and sellers, as uninformed money believe. So the 10% in any field do the thing that 90% of those in that field do not do. If 10% are making the bulk of the money, 90% are making just a fragment. Understand? So in this marketplace, the small persons, the market makers, they are not big, just a close set. They're not large, but retail traders and uninformed money, they are large. They are large. They are large. They are large. Understand? So these persons control, they don't do what the large persons do, is counterparty. So when they come into hunt, they are always there to push price to the way they want. The big banks are the market makers. The market is their playhouse, and they drive price using IPTA, what's called IPTA. That's the algorithm responsible for driving price. It's your interbank price delivery algorithm to engineer profits for them, thereby exploiting uninformed money. So that's just the way the market works. It works with respect to the big players, the market makers hunting uninformed money. Thus happens in every sphere of life, every space. You see the same thing playing out. So the 90-10% rule also applies for the foreign exchange market. You see, even in the crypto space, you hear that a lot, that a particular billionaire moved his coins or moved his money from a particular, and you see the whole thing drop. How can one person move a market? One person, just one person move a market. That's to tell you how controlled it is. Understand? So in this Forex market, certainly speaking, I prefer Forex more than any other asset class. And that's because I've been able to flow with it, and I've seen the consistency, and I just like it. So to develop the institutional trading mindset, you will need to grab the following. When starting this course, I told you that I know this model down to my fingertips. I know the position trading model, the swing trading model, the day trading model, and also the short term. So when we say position trading, we are talking about trading the monthly effect entering on the daily time frame. Daily here is represented in D1. So your daily time frame, that's the time frame you enter, but you trade the monthly effect. You see, position traders, they keep trades to run for months. Understand? They keep trade for months. The big player, the banks, they trade this kind of trading. So they trade for months. Their trade is still on. They don't come out, and they just trade there. So next we have swing traders who trade for weeks. They keep trade for weeks. They trade the weekly effect entering on the 4-hour time frame. The short-term traders, just like myself, we trade the weekly range entering on the 1-hour time frame. So our trade can stay for a day or days. And day traders, I do short-term and I do day trading. We trade the daily range entering on the 15 minutes time frame. Now, these are traders that want to trade what happens in a day. I major on short-term trading and day trading. Also, we have scalpers, those that take minute fragments of price as it goes up or down. They are in this minute, and the next 3 minutes they're out. The next 5 minutes they're out. It's a style of trading, but I can do that, but I don't majorly I don't take it up as my style of trading because of my lifestyle. I'm occupied most of the time, and it does not suit my lifestyle. But when I come in and I have chance, I come in, I look at my screen, and I see an opportunity to profit from short term, like a scalper, I do take such position, but rarely do I do that. Rarely do I do that. I stick to short term and day trading because I can just place a trade, go on with my activities, come back, and I see that I've made profit. Or even if I made a loss, I can know how to strategize for the next trade coming up. So price books, according to where markets are driving into. Now, want to know why does price go up and down? It's good for liquidity, yes, but where is this liquidity? What are the factors that base for the algorithm to book price to go for liquidity? So I say it's also important to know that price generates up and down due to the following: the quest for liquidity. Now, where is liquidity? Liquidity is seen in form of old highs and lows. Old highs and lows. That's where most retail traders, they think that it's a form of resistance or it's a form of support. That means the market will not go above that place, and when they are buying, when they are selling, and it not go below that place when they are buying. Like I said in the previous lesson, that when you're buying, you expect the price to go up. When you're selling, you expect the price to come down. So when you're selling, your stop loss, that means your exit point on a loss, will be up. And when you're buying, your stop loss will be down. So that stop loss is where they're looking at liquidity. If you are buying, most times you keep your stop loss on a low because you think it's a support. It's not go below that place, but they will shock you. They will take it out because that's where they're coming for liquidity. And I will not just say anything here. I will also tell you how it happens on your chart. The next one is that they take price up and down for the purpose of rebalancing and imbalance. So we have two types of this. We have sell side imbalance, buy side inefficiency, and buy side imbalance, sell side inefficiency, BC. So don't mind the big language. I'm going to tell you what it means. So rebalancing and imbalance, what this means is that when the market trades too much up, it wants to cover up because of it has kept a void in the marketplace. It has spilled up too much, so it wants to cover up the excess portion. Even if they are taking price up, it wants to fill up some of the void it has left because of the large inclination up. So it wants to fill that void down a little bit, then continue the up move. So they are still buying, but they are coming down to fill up the void and also add more orders. So that's where they add more orders. So if they are buying down and they take it up, when they come down, when they retrace the price down, understand, back into the recently created price range, they add more orders to still book up because their orders are so large that all cannot come out the same time because of their large entities. All cannot come out at the same time. So their orders come in bits. So once they push out one order, they take price up, they also bring it down to add more orders. They take price up again, bring it down to add more orders. So they keep loading orders as it's going up. But as it's going up, if they are buying, it's going up and coming down, going up and coming down. They also look for the quest for liquidity. They are also going for liquidity. Anytime they drive price up and down, they're going for liquidity and to fill an imbalance. So when the market is selling and they are buying, when it is selling, it is coming down and it is creating large voids. They are selling, they are spilling price down, they are selling. It needs to come up back to close the void and continue their sell. So we call that sell side imbalance. The sell side is imbalanced because of it was too much. Then the buy side is inefficient to cover the whole sell side because of that's their main orders to sell. Then the buy side imbalance, sell side inefficiency. The buy side will be too much. So the buy side is not balanced because of they're taking price up. So the buy side is imbalanced to take price in that direction. So when they are bringing the sell side, it will be inefficient to cover up the whole void on the buy side that was being created. So I will show you all this practically on the chart. So this market maker drive price up and down for two reasons as explained above, but this is done with respect to the current tide of the market. So if they are buying up, the tide is a bullish tide. We call it a bullish tide. The tide is buying. They are in a bullish tide. If they are selling, we say it is bearish. When you look at the forex market, you're going to see a bull and a bear fighting. Sometimes it is a symbol of wealth. Understand? So bulls mean that it is going up. Bears means that it's coming down. When I say I'm a bull, that means I'm a buyer of a particular currency or instrument. Then if I say I'm a bear, that means I'm a seller of this. If I said, where are all the bears? That means where are all the sellers? Where are all the bulls? The buyers. Understand? So understand. So on that name that it used to represent up movement and down movement, when we say I want to go long means to buy, short means to sell. So bull means a buyer, bear means a seller. Long means to buy, short means to sell. If I say I want to short GBP USD, that means I want to sell GBP USD. If I want to say go long on Euro USD, that means I'm saying buy Euro USD. Those are just terms we use in the forex space here. So bullish is another flow. So I said here now that bullish means that it's going up, it is buying. So the tide of the market makers, they go for liquidity and they rebalance and imbalance with respect to the tide of the market. So what is tide of the market? It's where they are driving price to. And this tide of the market is being seen in two forms. One is bullish is order flow, and next one is bearish is order flow. Now, bullish means that it is going up, and bearish means that it's coming down. Look at what I said here, that bulls, I seen it bulls and bears. So bearish, bullish, understand? So bearish is order flow. When we see it, the market will be making higher highs. Then it will be going up and higher lows. I'll explain that for you. Then when it's coming down, that means bearish is order flow to making lower lows, LL, and lower highs, LH. So the market makers continuously move price to regions they can offset majority of uniform money, because when these ones are being taken out by liquidation of their trading order, that stop loss orders, the market makers, they make their profit. So let's go to the chart and see and understand how this model works. So I'll be explaining the quest for liquidity. That means by taking old highs and lows, rebalancing and imbalance. And I'll be talking about how they do this too with respect to your bullish and bearish institutional order flow. I will be explaining how they do that with respect to the current tide of the marketplace. So this is a lesson you need to take your time and really watch and rewatch it over and over, because the more you watch it, the more you learn more things. So let us go to the chart right now. Okay, so this is tradingview.com. You can browse about it to take you here. Tradingview.com, then you go to your charts to take it here. Understand? So that's the site I'm using to do this, or else you can use your MetaTrader 4, MetaTrader 5, any one that your broker gives you. You can also install it using your devices and all the rest. So I want to explain the model with which the market makers they use to drive price up and down. So this chart, I not premeditate this. It's just an example that just popped up, and I want to use that. It's not, we can use something else, or let me use something else so I cannot be as if let me use something else. Okay, so let's use here. So the markets, these are time frames. They are called time frames. This is 1 minute time frame, 5 minute time frame, 15-minute time frame, 1 hour, 4 hours, daily time frame, weekly time frame, monthly time frame. Is your 3 months time frame, 6 months time frame, and 12 months, that's a year. So I'm toggling between those time frames. If I shift it to daily, you're going to see that each of these candles here represent a day. So you see here, this is Tuesday, the 6th of September. If you check down here, you see time. So this here is time, and this here is your price. So just like X and Y axis, this Y axis, the X axis rather, it represents your time, your dates. Then the Y axis represents your price. So all these candles on this daily time frame, they represent 1 day. So it took 1 full day for this candle to form. If I shift it, you're going to see this was 7th of September 2022. Now this is 8th of September 2022, and all the rest. So now watch now. I said that the market, first of all, it goes up or down for quest for liquidity, and the quest for liquidity can be seen in the form of what? Old highs and lows. Take a look at when they took out old highs and lows, how they want to sell. Look at now, they want to sell. They are selling from here now, they are selling. The market is bearish. It's a bearish institutional order flow. If you go to the previous slide, you will see what I'm talking about. It's a bearish institutional order flow. And we said in a bearish institutional order flow, the market will make it what? Lower lows and lower highs. So I said lower lows and lower highs. Sorry about that. So if the market is bearish, it will be making lower lows and lower highs. Make that capital letter. Make it somehow bold for you to see. So this is a lower low. It's my bold. So this is a low. The market made a lower low to this low now. Look at, so this is a lower low to this low. This is a low in the marketplace. It's a low. This is a high. This is a high. This is a high. It's a high. You see, this is a low. This is a high. This is a high. This is a high. This is a low. This is a low. This is a high. This is a high. So the market made a lower low to this low. So if you can mark out all the lower lows, we're going to see something like this. Even if I don't mark all, you understand what I'm talking about. So when the market it is selling, it is a bearish institutional order flow. So the market now is in a bearish institutional order flow. I will just say bearish IOF, institutional order flow. So this was what it was doing when it was coming down in this nature. We saw the market coming down in this nature. Okay, sorry about that. I went to put the arrow is meant to be here. Okay, so now look at the market is coming down. So the red candles represent that the market is going down. The green candle means that it is going up. So